Hi, my name is Jordan Wilson. Today, we're going to take a look at exchange-traded funds and how they compare with the open-end mutual funds that we looked at in some of the previous episodes. So let's get started. Our objectives today are to look at the trading aspect of ETFs versus mutual funds, transaction costs, and the expense ratios. The first comparison I'd like to make is on trading. So exchange-traded funds are going to be preferable if you're a heavy trader. You're very active. Maybe you're a day trader. And the reason they're preferable is because you can trade them many times during the course of a day. Unlike a mutual fund, which you have to wait till the end of business day, assuming it's valued on a daily basis, and then buy or sell with the fund company. Now, this isn't really an issue for what I would call a normal investor. You're going to have overall a long-term outlook. So the ups and downs of a single day aren't really of interest. That means mutual funds will be fine. It does maybe give you a little bit of comfort in case of a market crash, or if you're concerned about a market crash, just having that knowledge that, okay, if the market crashes 10% in one day, maybe I can sell my ETF and only lose 3% or 5%. Whereas the person that holds the mutual fund will have to wait till the close of business and suffer the entire 10% loss. But again, overall, I think if we look at the long term, it's not a big deal. And as your shorter term financial objectives approach, you'll have moved your investment capital that's allocated to that goal into more stable, so less volatile, more liquid investments because you want to have that certainty as your target date approaches. And liquid, safe, stable investments probably won't be a big factor if there's a market crash. The second item to discuss here would be the liquidity. Now, we just went through the fact that ETFs can trade continuously through the open trading hours. That means that they tend to be much more liquid than a mutual fund that's maybe only valued and traded once a day, or there's still some mutual funds out there that may only be valued weekly or bi-weekly. So on the surface, ETFs are much more liquid. However, ETFs trade on stock markets. And so that means there's supply and demand. You need to have a buyer if you wish to sell. If you wish to purchase, you need to find someone that's willing to sell to you at a price you're happy with. So in the extent that there's a market crash, maybe no one wants to buy. You're selling because you think the markets are going to continue down. So why, if I'm on the other side of the trade, why would I want to buy your shares? So you might find less demand when you go to sell. Conversely, in a boom market where everything's going up and you think the markets are going to continue to go up, again, if I'm on the other side of the trade and I think the markets are going to go up, why would I sell to you? So again, that's an issue in liquidity and especially in market crashes, is finding someone that will take your shares off your hand. Now, a fund company is there to buy or sell its mutual fund units. So yes, you'll take the full hit for that day as the price falls, but the company will redeem your units at that end of day. Now, the question mark there, or the little asterisk, is that when you enter into a deal with a specific fund company, you should review and make sure that the company is large, stable, and that a market crash isn't going to make them go out of business or shut their doors. So you want to deal with a quality company that even in a bad time will be there and have the liquidity to redeem your units. The other point I'd make on liquidity is that with a mutual fund, there's really no limitation on the number of units that can be issued. So if I want to buy units in a specific fund, the fund company can issue them to me. It just adjusts all the NAV for the other. But with an ETF, there's a finite number of shares issued and outstanding. So when I buy an ETF, I want to look and make sure that there's enough liquidity out there in the number of shares so that if there is a market correction or a boom, I'm not stranded. And part of that would be looking at what's the average daily trading volume. So how many shares or how many units of that ETF trade on a daily basis? If it's 1,000 and I own 500 shares, there's a good chance I won't be able to get out in a hurry. But if I own 500 shares and the average daily volume is 50 million, I can move in and out pretty easily. So I would be looking at the average trading volume. I'd also look at the number of units or shares outstanding. And the final thing I would probably look at, especially for smaller, less liquid ETFs, is the bid-ask spread. So if I want to purchase a common share of a company or a share of an ETF, I put in a bid for a certain number of shares at a certain price. And if someone on the other side has an offer outstanding for the same amount, we basically shake hands and I buy the shares off the other person. But if you have a very illiquid company that doesn't trade a lot or doesn't have a lot of outstanding and issued shares, maybe I want to buy 1,000 shares at $10 a share. That's what I think is fair. But I look out there on the bid-ask spread and I see, oh, there's only 100 shares on offer at $10. And if I want to fill out the rest of that order, I have to go $12 for the next 200, $15 for the next 400, and so on. So the less liquid a common stock, or in this case an ETF is, the more impact on your price as you try to fill relatively larger orders. And again, if you're dealing with a fund company, that's not an issue. The next aspect on trading would be flexibility. We just talked about how ETFs you can buy, sell continuously during the trading hours. But they also operate in many jurisdictions exactly like common shares. You can put in a limit order. So I'd like to buy shares of this ETF, 1,000 shares at $10. And I'll wait until that order fills at that $10. I'm not going to get trapped into a at market order where, in the example we just gave, I could only fill 100 shares at the 10. And then if I wanted the rest of them, I had to go 12, 15, and so on. So a limit order can give you some protection. You could also enter stop loss orders, things you cannot do with open-end mutual funds. And some jurisdictions may allow you to short ETFs. So that's where you're borrowing something you don't own, selling it in the hope, expectation that the price will fall. You can then purchase the common shares or the ETF, hand that over to the person that you borrowed to short, and the difference is your profit. So again, a little bit more flexibility with the ETFs. Transaction costs. We went through that a bit with the mutual funds. Open-end mutual funds may or may not have a sales commission, a load. That could be a front-end load, a back-end load, a declining load. And I think that since we're talking exchange-traded funds and we're talking primarily passive index investing, I don't think you should be paying a sales commission on an index fund, even if you're going with a mutual fund. There's just so much competition, and really it's just an index fund. Why would I pay someone for the privilege to purchase a passive index fund? It makes no sense. So there's probably no way on an index fund, if we're comparing to ETFs, that you're going to pay a sales charge. Now, with the ETFs, you'll probably end up paying a broker's commission when you buy or sell the ETF through your bank, through your investment house, however you trade. And often these things are dependent on the assets that you have with the institution. But for example, every trade might be $9.99. Not a whole lot. And if you have $50,000 or $100,000 in the account, maybe it's $4.99. Not even the price of a venti latte at Starbucks. Who cares? And that's sort of the idea behind these banks. And if you don't have the asset volume, what you also see is if you trade 150 transactions in a quarter, we give you the lower rate. So it's an incentive for you to trade more. And the more you trade, even at a lower amount, provides the bank with more revenue. I was going to say a bit of a scam, but it's a bit of a scam. So you're going to pay transaction costs when you buy or sell ETFs. And you won't pay those when you're buying a mutual fund. Now, what you'll see a lot of out there these days, some good, some bad ETFs, is that a lot of financial institutions are offering either what they call zero fee ETFs or no transaction fee ETFs. And that's to sort of try to incent people. So if I've got 100 different choices of TSX 300 index funds out there, maybe it's nice that I don't have to pay a transaction cost. So there's an arrangement between the ETF issuer and the financial institution that they'll basically cover the cost of the transaction fee. And really, why is this an issue if I'm only going to pay $10 a trade? Well, a lot of investors, not just young starting out, but they only put aside maybe $300 a month if they want to invest in mutual funds or ETFs. And so if I have $300 and every time I'm buying something, I'm shelling out $10 in fees on a percentage basis against whatever return you expect, and we talked equities, and you're really only looking at about 6 or 7% for an expected return. That can add up over time. And what usually leads me to tell people that are investing in smaller amounts is to don't invest monthly. Save your money until you get a critical mass. Maybe that's every 3, 4, 6 months, and then make your purchases. because over time, even those little small fees will add up and really hurt your returns and your accumulated growth. So that's an issue. But again, the thing to watch out with these no transaction fee funds is maybe there's a reason why they're trying to give you a deal to buy them. Maybe they have poor tracking error. So you're hurting at times on your returns versus the benchmark index. Perhaps it's not the best reputation or best financed fund company that's issuing the ETFs. So there's that sort of risk premium. So I think that it's a bit of a trade-off. And I know some people just, their ears perk up when they don't have to pay the transaction fee. But make sure the underlying reasons for going into an index fund in the first place, the matching of the market return, so minimal tracking error, low to no management expense ratios, these sort of things aren't just pushed aside because, oh, I don't have to pay a transaction fee. The final point I'd like to make here on transaction costs is tax efficiency. And I'm not going to get into this too deeply because it's very dependent on tax jurisdictions. So where you live will play a part in what may or may not be the better option. Now, I think in general, though, that the perception in many jurisdictions is that exchange-traded funds are better from a tax perspective. And that's mostly because of how they do or do not flow out taxable income, capital gains, for example, versus a mutual fund, which does. And again, it's less of an issue because today I think a lot of the smaller investors are heavily into tax deferred or tax-free accounts. So in the States, say your IRA, or in Canada, your RRSP for a tax deferred, and then your tax-free savings account as well. So if you're sheltering your income for now, then worrying about the tax efficiency isn't as big a deal. But that said, tax is a huge drag, perhaps the biggest drag on your ability to grow your money over time and enjoy the compound returns. So if you are holding your assets outside a tax-deferred or tax-free account, then this is hugely important to make sure that you understand which is the more tax-efficient structure, a mutual fund or an ETF, and act accordingly. Then we get into the fund expenses. We spend a lot of time on management expense ratios with mutual funds. The thing I'd like to say here is mutual funds on average are much more expensive than ETFs. Now, the reason for that, in large part, is that most mutual funds are still actively managed. So there's more work involved. You have to pay a manager to run the fund, whereas the ETFs have tended historically to be more passive index funds. So it's a bit of apples and oranges when you just sort of look and say, okay, ETFs are cheap, mutual funds are expensive. You need to sort of compare apples to apples. So when you're looking at a TSX 300 or a NASDAQ 100 index fund, and you're faced with a mutual fund in one hand and an ETF in the other, that's the apples to apples. And then you can compare the cost structure. So I think that's probably, the first thing you need to do is just, some people still assume that ETFs are the cheaper way to go, but that's not quite true. Now, overall, I think ETFs still are the cheaper structures, But it can go both ways depending on the location you're in. Canada historically has had some of the world's highest mutual fund fees. But then a few years ago, BlackRock with its iShares offering of ETFs and Vanguard Canada came into existence. And that competition, and it was a huge distortion in prices between mutual funds, has caused the mutual fund companies to put pen to paper a bit and reduce their costs. Still not as good as I would think they could do, but costs are coming down. You're also seeing more mutual funds enter the passive field. And because there's no management involved with that, their costs are quite comparable. The other thing you're going to see a lot of is the economies of scale. Now, Vanguard and BlackRock aren't altruistic. They're not good corporate citizens that want to give you a good deal. But they have such a huge infrastructure that they spread their costs out so well that on a per investor basis for a management expense ratio, they are very, very inexpensive. And there's not a lot of fund companies out there, Fidelity would be one, that can compete with them on a size basis. So that economies of scale drives their costs down. As I say on the slide here, I think we're still at a point where the ETFs have lower MERs, even in passively managed index funds, but it is tightening. And again, the downside with the ETFs is you may have slightly lower expense ratios, but if you have to pay broker's fees every time you go buy or sell, maybe that offsets the 1 or 2 basis points you're saving by going with an ETF. So something to consider. And then I just sort of point out keys to the costs. Don't assume that ETFs will be cheaper than mutual funds. Do an apples to apples comparison and find the net cheapest after you factor out transaction fees and tax efficiency and all that stuff. And even in the same segment, what you often see is there's a wide variation in costs. So if we're looking at the Canadian equity market and I want a TSX 300 or TSX 60 index fund, don't just grab the first one you see. There's going to be a variation in costs. And again, that often driven by the economies of scale. A smaller fund company is naturally going to have a higher cost. Or in Canada, you might see a company like Horizon, which does a lot of synthetic ETFs. So they're able to keep their cost structure rather low, despite it being on a relative basis much smaller than iShares or Vanguard's offering. Lowest cost is often the best, but you want to watch the tracking error, and that's how closely the return matches the market. So again, going cheap is fine, but if you're losing on the performance side, then that's a cost. And then, as I said before, the transaction fees on ETFs, if you're buying and selling constantly, or even if you're just adding to your portfolio on a monthly basis, that can add up, and it may make mutual funds a slightly better alternative. So I think that's just an overview on the cost side. I think ETFs tend to be more cost effective, at least in Western Canada where I'm based, but it's tightening, and I wouldn't discount mutual funds altogether. And when I do my own analysis for clients, I look at everything anyways, and you never know what new products might come along that might be effective. So don't just assume the ETFs are the best, even though they may in fact be. That's all for today on comparison of ETFs versus open-end mutual funds on a cost basis and a trading basis. We'll look a bit more at the comparison of the two when we come back in our next episode. Thank you for listening in today.